Have you ever wondered, why do the rich keep getting richer despite crises, volatility, or recessions? It's not because they know a secret that ordinary people don't. It's because they possess a completely different investment mindset, sharp, long-term, and action-oriented. In this video, we will break down 5 types of assets that billionaires are investing in right now, from stocks, real estate, private equity, alternative assets to bonds. But we won't stop at the what. We will dive into the why and how, so you can start building wealth like the rich. Get ready, because the journey into the financial mindset of the ultra-wealthy begins right now. Stocks, the art of ownership, not gambling. Stocks are not codes you flip for quick profits. They are fractional ownership in real businesses. When you invest in stocks with the right mindset, you're no longer an outsider. You become a shareholder, a strategic participant in that company's long-term vision. The wealthy don't chase market noise. They buy into operations, cash flow, and growth. They don't look for what's cheap. They look for what's valuable over time. That's why equities are the foundation of long-term wealth. The key is ownership, not speculation. Wealth is created through participation in solid enterprises, not by reacting to daily fluctuations. Success in the stock market isn't about luck. It's about selecting companies with strong fundamentals, consistent revenue, scalable business models, healthy balance sheets, competitive advantage, and transparent leadership. Investors don't randomly pick stocks. They own businesses they believe in. Cash-flowing companies that pay regular dividends become passive income machines. The smart strategy is not timing the market, but time in the market. And when you reinvest dividends, you unlock compounding, the most powerful force in wealth creation. The wealthy use this tactic relentlessly, allowing their capital to multiply without needing to trade or time exits. Smart investors detach from short-term emotions. They apply dollar-cost averaging, investing a fixed amount regularly, regardless of market swings. This flattens volatility and builds consistency. When markets fall, they buy more shares. When markets rise, their positions grow. This method eliminates paralysis from overanalyzing when to buy. You don't need to be perfect, you need to be disciplined. The wealthy don't guess market bottoms. They deploy capital consistently and stay invested. Your advantage isn't prediction, it's participation. Build wealth like a system, not a gamble. Long-term investing wins not by being right often, but by being steady always. Another approach is investing in index funds. Rather than hand-picking stocks, you gain exposure to hundreds of the best companies through a single investment. Funds like the S&P 500 reflect the overall economy and are used even by the ultra-wealthy to preserve and grow capital without micromanaging. You minimize risk through diversification and maximize time efficiency. This method is ideal for beginners and veterans alike. You don't need complex strategies. You need consistency and focus. Wealth is not about being clever. It's about having a process. Index investing offers just that: low cost, high performance, and reliable growth. In summary, stock investing isn't gambling with prices. It's building wealth through ownership. Choose companies with a long-term edge. Focus on businesses that pay you while you sleep. Reinvest that cash flow. Be consistent with your contribution. Ignore market drama. And never invest with hope. Invest with a plan. This is the true difference between someone who trades and someone who builds. The rich don't gamble their future, they engineer it. And you can do the same. It starts with a shift in perspective. From trader to owner, from noise to fundamentals, from emotion to execution. Real estate. Cash flow over luxury. Real estate isn't about flashy homes or impressive views. It's a tool, a high-leverage income-generating machine that produces 2 things every investor needs: cash flow and appreciation. The wealthy don't just buy property for status, they buy for performance. When done right, real estate becomes a double engine. Rental income feeds your cash flow, and the property itself gains value over time. That's why real estate remains a cornerstone in nearly every serious portfolio. It's not just a place to live, it's a financial asset that pays you. Smart investors buy income streams, not wallpaper. Strategic real estate investing begins with numbers, not emotions. Savvy investors analyze location, infrastructure, occupancy rates, tax impact, and the potential for long-term value growth. They calculate expected cash flow and use data to decide, not personal taste. Every property is evaluated as a business unit. Is it producing a positive return after costs? What's the ROI over 10 years? What is the exit potential? This is how high-level investors think. Real estate isn't emotional, it's mathematical. And those who master the numbers unlock a source of stable, inflation-resistant income that compounds silently, month after month. One of the most powerful tools in real estate is leverage. The wealthy rarely buy properties with 100% cash. They use other people's money, banks or private lenders, and let rental income pay off that debt over time. This amplifies returns and preserves capital. The equity grows and your cash investment remains minimal. You control a large asset with a smaller outlay. The appreciation builds in your favor while someone else pays your loan. That's not risk, that's precision. Smart leverage lets you scale faster and gain exposure to multiple assets without tying up all your liquidity. You don't need millions to start. Platforms like REITs, real estate investment trusts, let you invest fractionally in income-producing properties and collect dividends without owning or managing a building. You can also use the house hacking model. Buy a multi-unit property, live in one unit, and rent out the others. This offsets your mortgage and builds equity fast. The key is thinking like an investor, not a tenant. Real estate isn't just a place to stay, it's a long-term money machine. You just need to approach it with data, discipline, and a clear exit or growth strategy. Real estate won't make you rich overnight, but it will make you wealthy over time if you treat it like a business. Focus on deals that produce monthly cash flow and long-term value. Don't chase trendy neighborhoods, chase fundamentals. Know your numbers. Use leverage smartly, maximize tax benefits, and always protect your downside. Real estate is not a trophy, it's a system. Once it's in motion, it works for you 24/7. That's how true wealth compounds, through assets that generate income while you focus on the next opportunity. Own properties, or better yet, own cash-flowing systems. Private equity, investing before the world notices. Private equity is where wealth is made quietly and exponentially. It's the arena where investors fund private businesses before they go public, before the market even knows they exist. These companies are in early or growth stages, with huge upside potential and limited public attention. This is not gambling. It's asymmetric investing. Small capital, massive upside, longer horizon. When chosen wisely, a single private equity deal can yield returns that dwarf public stock investments. The catch? It requires vision, patience, and high conviction. The rich don't wait for IPOs, they're already in long before the headlines break. Private equity is not just about capital, it's about value creation. Investors don't just inject money, they provide connections, strategic input, advisory power, and board-level influence. This active involvement turns capital into acceleration. Private equity participants become part of the business growth story. They co-engineer outcomes. It's a model of engaged ownership where value is multiplied through insight, execution, and network effects. This is how insiders turn 100K into millions. Not because of luck, but because of leverage and access. The wealthy don't just fund ideas, they shape them. And in doing so, they unlock transformational results. You no longer need to be ultra-wealthy to enter this space. Crowdfunding platforms like Republic, Seed Invest, and AngelList have opened doors to retail investors. With as little as a few $1,000s, you can back startups with scalable potential. But access alone is not enough. You must vet the team, study the business model, assess market demand, and analyze growth paths. In private equity, due diligence is the armor. Success requires you to think like a venture capitalist, not a dreamer. Every investment is a bet on the future, and only well-informed bets deserve your capital. One truth about private equity: liquidity is limited. You may need to hold for 3 to 7 years before seeing a return. This isn't for people chasing quick exits, but that illiquidity is what allows patient capital to grow undisturbed. The richest investors aren't flipping stocks, they're planting trees. While others check prices daily, they quietly nurture assets with 10x potential. And when the exit arrives, whether through acquisition or IPO, the reward is often game-changing. If you can afford the wait and do the research, private equity is one of the sharpest tools in your wealth arsenal. Private equity isn't just an investment. It's a mindset. It's the discipline to act early, before validation, and the clarity to know what's worth backing. It's the courage to tie up capital today for exponential gain tomorrow. The wealthiest don't play in obvious spaces. They find value where others hesitate. If you adopt the same mentality, filtering hard, diversifying wisely, and holding firm, you can access opportunities the public won't see until they're priced out. Private equity is for the bold, the strategic, and the patient. That's how fortunes are made, before the market wakes up. Alternative assets, diversifying beyond the obvious. Alternative assets are the unsung heroes of real wealth. These are investments outside the typical triad of stocks, bonds, and real estate. Think fine art, vintage wine, farmland, cryptocurrency, rare collectibles, and precious metals. Why do the wealthy love them? Because these assets behave differently. They're often uncorrelated with traditional markets, which makes them ideal for buffering volatility. When stocks crash, rare assets often hold or even increase in value. In other words, they're not just different, they're defensive and opportunistic. For the elite, these are tools of preservation, protection, and unorthodox profit. What makes alternative assets special isn't just performance, it's access and scarcity. There's only one original of a painting, only so much fine wine, only so much arable farmland. These limitations create inherent value, but beyond supply and demand, they carry emotional and cultural weight, making them attractive to affluent buyers. And as demand grows globally, so does value. The wealthy don't think in quarters, they think in generations. That's why they buy assets that transcend markets and outlast cycles. In their playbook, preservation is just as important as multiplication. Alternatives provide both, when used wisely. Today, technology makes it easier than ever to get started. Platforms like Masterworks let you buy fractional shares of fine art. Vinovest lets you invest in high-end wine without owning a cellar. Real estate-backed agricultural REITs let you hold farmland without farming. Cryptocurrency opens doors to digital scarcity. These options offer real exposure, without traditional barriers. You no longer need millions to play this game. What you do need is research, a risk-adjusted mindset, and intentional portfolio design. Alternatives aren't toys, they're tactical assets, and they become powerful when they're part of a bigger strategy, not isolated bets. Of course, alternative assets are not for the uninformed. Each category has its own rules, risks, and metrics. Art needs authentication. Wine needs climate control. Crypto requires cybersecurity. Farmland depends on yield and location. These aren't set-it-and-forget-it investments. You must understand your entry, your exit, and how value is created. This is the part where most fail. They jump into trends without understanding fundamentals. Don't be that investor. Study. Start small. Learn the nuances. The wealthy succeed here not because they know everything, but because they know enough to control risk and compound gains. Ideal allocation for alternatives? Typically 5 to 15% of your portfolio, just enough to add a new growth vector and a layer of resilience. Spread risk across categories, 1 part digital, 1 part tangible, 1 part yield producing. Always connect each asset to a purpose. Hedge inflation, store value, preserve wealth, or diversify risk. And never confuse novelty with quality. Wealth isn't built on what's new, it's built on what works. When alternatives are used strategically, not emotionally, they become force multipliers. Because sometimes the best opportunities lie just outside the spotlight, waiting for someone bold enough to act. Bonds, the silent anchor of every strong portfolio. Bonds are not flashy, but they're foundational. In times of market chaos, bonds provide a safety net of predictable income and capital preservation. They are the quiet workhorses in a diversified portfolio. Bonds generate fixed interest payments and maintain value even when equities tumble. For wealthy investors, bonds are not about chasing returns, but about securing resilience. They allow portfolios to weather volatility while still generating steady cash flow. Think of them as the ballast in a ship, invisible when seas are calm, but critical when storms hit. True wealth management always includes a strong defensive line. The beauty of bonds lies in their consistency. Treasury bonds offer virtually risk-free returns backed by government security. Municipal bonds come with tax advantages, especially valuable for high-net-worth investors. Corporate bonds pay more, but require credit analysis. Bond ETFs allow instant diversification across maturities and sectors with low cost and high liquidity. No matter the type, bonds pay you to wait. They don't require market timing. They simply deliver steady income on schedule. That predictability is why sophisticated investors use them to stabilize portfolios and fund other strategies. In a world of uncertainty, consistency is an asset class on its own. Bonds aren't about excitement, they're about control. When stocks are soaring, bonds look boring. But when stocks collapse, bonds offer peace of mind. They act as shock absorbers during downturns. That's why smart investors never go all in on risk. They hedge with stability. Bonds smooth out returns and reduce the overall drawdown of your portfolio. This isn't speculation, this is structure. The goal of wealth building isn't to impress, it's to endure. A well-balanced portfolio isn't just about growing fast, but about never going backward too far. Bonds keep you in the game when others get wiped out. Bonds also serve a key function in cash flow planning. If you're nearing retirement or building passive income systems, bond ladders can offer regular payouts. These structured portfolios hold bonds that mature in sequence, releasing capital and income at predictable intervals. That kind of visibility matters. It helps fund living expenses, reinvest opportunities, or cover downturns elsewhere. Bonds aren't just safe, they're strategic. They give you time, options, and breathing room. The wealthy don't use bonds for thrills, they use them to maintain control. Because losing money is more costly than missing out. Stability isn't a luxury, it's leverage. If you're new to bonds, start simple. Government treasuries or bond ETFs are great entry points. As your capital grows, explore more advanced instruments like municipal bonds for tax efficiency or high-grade corporates for yield. But never underestimate their value just because they're boring. In a portfolio built for long-term wealth, boring is beautiful. Bonds let you play offense more aggressively with other assets, knowing you've protected your downside. That balance, growth plus defense, is what keeps the wealthy wealthy. In a world that celebrates speed, bonds are proof that endurance still wins. Silence doesn't mean weakness, it means strength. Cash flow and risk management, the billionaire mindset in action. Wealth isn't measured by assets, it's measured by cash flow. The truly wealthy don't just accumulate things, they acquire systems that generate income, month after month, whether they work or not. Rental properties, dividend stocks, interest-bearing bonds, and business equity all produce predictable, recurring income. That's the real goal, not just to grow your net worth, but to fund your lifestyle without touching principal. When your assets pay for your life, you're financially free. The rich don't focus on ownership alone, they focus on income generation. Cash flow is the fuel that turns financial plans into real freedom. But cash flow only works if paired with control. That's why elite investors obsess over risk management. They don't fear volatility, they prepare for it. Their portfolios are built like teams. Every asset has a job. Equities for growth, bonds for stability, real estate for yield, private equity for asymmetric upside, alternatives for hedging. This is asset allocation with intention. Nothing is random. Diversification isn't just a buzzword, it's protection. When one engine stalls, others keep the system moving. This is how the wealthy sleep at night. They don't eliminate risk, they neutralize it through structure and design. Leverage is another secret, and it cuts both ways. Used poorly, it destroys portfolios. Used wisely, it multiplies results. The wealthy borrow not to consume, but to expand. They use leverage to control larger assets that produce higher income than the cost of debt. That gap, the spread, is profit. But it only works when managed tightly. Every leverage position must be cash flow positive. If it isn't, it's a liability, not an asset. Leverage is a tool, not a crutch. Used with discipline, it's a weapon. Used carelessly, it's a bomb. The difference is education and restraint. Hedging is another powerful defense mechanism. Wealthy investors always have a plan B. Cash reserves, precious metals, inflation-protected securities, and uncorrelated assets that act as shock absorbers. They assume chaos will come and position accordingly. They don't overexpose themselves, they build redundancy into their systems. This mindset is what separates amateurs from professionals. In financial storms, the unprepared drown. The prepared pivot. Risk is inevitable. Ruin is not. When you hedge, you buy time. And time is the most powerful financial asset of all. The rich use it to reassess, reposition, and relaunch, while others are still reacting. Ultimately, wealth isn't about luck, timing, or secret hacks. It's about systems. Systems that generate cash flow, absorb risk, and grow intelligently. Systems you build once and refine forever. Systems that turn income into assets and assets into freedom. The rich don't rely on emotion, they rely on frameworks. And so can you. Build your financial engine one piece at a time. Stay consistent, learn relentlessly, act deliberately. The journey to wealth is not explosive, it's exponential. Not overnight, but over time. Start now, not someday. Because wealth isn't just built by those who know, it's built by those who move. In conclusion, owning assets is not the destination, but the means to lead you to true freedom. Through the 5 types of assets that the ultra-wealthy are investing in, from stocks, real estate, private equity, alternative assets to bonds, you can see clearly. Wealth does not come from lucky opportunities, but from strategy, cash flow, and intelligent risk management. Now is the time to start applying. Small, consistent steps with a long-term mindset. Don't wait for everything to be perfect before acting, because the only difference between those who build wealth and those who stand still is the action taken today. Your financial future begins with the decision you make right now.